the purpose of today is to educate the community on what it takes to become a homeowner, maintaining your home, and what the benefits are of home ownership, that intergenerational wealth piece that that home ownership is the key to, right? So we have a lot of different presenters today. We're going to start with Gino Tosi, who is our president? Yeah, the board president. Thank you. And then we have Tom Kowiak from the Fair Housing Center of Detroit, who will give us some history on fair housing. Then we'll talk about different things about loans, and we have many presenters on that. I'll tell you when we get to it. Hello, welcome. Come on in. Take a seat. We're just getting started, so great timing. And by the way, my name is Christine Crook. I am the chair of the Fair Housing Equity, Inclusion, and Diversity Committee. I may have said those three words out of order, but you know, it's all there. And so this today is presented by our committee through funds from the All In for Diversity campaign. Members of our board have contributed to this so that we, as a committee, can reach the community and teach them, again, about home ownership, what it takes to become one, maintaining your home, and accessing intergenerational wealth. So after we talk about loans, and we have 4 different presenters there, we're going to talk about title and deeds. Then we have taxes and appraisals after that. Then we'll have lunch, and you guys can chat and ask questions with the morning presenters. In the afternoon, after lunch, we'll have breakout sessions. We have 3 different breakout sessions. One of them is going to be in here, and that's inspections, home warranties, and home maintenance. The other one is intergenerational wealth, wills, estates, trusts. That's going to be in one of our rooms down this hall here. And then next to it, we'll have a breakout session about MSHDA and HUD stuff. Those things will run back to back, all at the same time, and you can pick 2 of the 3 to go to, right? So you could go to generational wealth first, and then to home inspections, or home inspections and then MSHDA. Okay? So we are going to get started now with Gino Tosi. Thank you so much.
So when you become a realtor, you also are joining the largest, or one of the largest trade associations in the United States. Being a part of the realtor brand means that you have a serious impact on the course of this country by deciding the fate of several people that don't know whether they're on the fence one way or the other about whether or not they want to be a homeowner, which is a major responsibility, but also the surest path to intergenerational wealth. So that's what the Realtor brand does. The Realtor brand also subscribes to a code of ethics that steps up the standard relative to the ethical standards for the state licensing authority. So the code of ethics broadly treats in 3 different categories how realtors treat other realtors and agents, how realtors have to treat the brokers, the state licensing authority, and also, finally, the public and the consumer, and that consumer-facing outreach. We also have other standards, such as fair housing. We have standards that are very important, and that we partner up with the national government through our Political Action Committee so that we can get laws passed so that fair housing is stringent, such as the expansion of the Elliott-Larsen Act. Another thing that we've done is trying to make housing more affordable so that a greater number of people can enjoy the fruits of home ownership.
Thank you so much for the opportunity to be here. I'm going to be real short, about 10 minutes or so. What is fair housing, why it matters, why it's important, why it's something that we can all agree upon, and what the effect of it is. The reality of it is the effect of fair housing is to enable people to buy homes, obtain mortgages, rent units, receive reasonable accommodations and reasonable modifications. It opens up housing. Opens up housing for people that are elderly. Opens up housing for families with children. It doesn't force someone to do something that they don't want to do. If someone is not qualified, they can certainly be turned down. That's not fair housing. Fair housing doesn't get into the standards necessarily. It just makes sure that whatever standards there are applied fairly. When it comes to real estate, when it comes to home purchasing, obviously we support it. That's the ultimate objective when it comes to someone seeking housing. home ownership. It is true, can't understate the facts, they are what they are. I saw one report where the average rental household had a net worth of, family had a net worth of 15,000. A family with a home, owned a home, has an average net worth, because home is such a largest asset that someone has, of $400,000. So that goes up and down with price, changes in the value of homes. I really think it's over $400,000 now. But it just tells you how important home ownership is. The sad part is, when you look at the data in that, especially with the black community, roughly 13% of the population, but only half ever apply for a loan. So many people are excluded out of the process. It's the same with Hispanics. And I think it's increasing even with some white populations, low-income white populations as well. We're not even considering home ownership, which is, one of the purposes of doing workshops like this, is to put that on people's mind, that home ownership is something achievable and the benefits that you have to do that. But right away, when those disparities occur, even before we get into what's taking place, once people enter the home buying process, there can be adverse treatments. So after they enter the process, we still have large disparities between black, Hispanic applicants and white applicants. It exists when it comes to lower origination rates, between loans that close. There's higher denial rates. And we have software lending patterns, and it shows that there's great discrepancies when it comes to subprime indicators. That's really disturbing. So at every step of the process, there's a problem with that. Another problem you see a lot with appraisal discrimination. We've done a number of, we have a couple of appraisal discrimination cases pending. Historically, right, minority, low-income communities have been valued lower than comparable properties or other kind of communities. And the real concerning part when it comes to an appraisal, because when a home closes at a certain price, that then becomes a benchmark. It becomes a comparable property or comparable sale to be used in future valuations. That's the way the process works. The problem is to get it where,
There are 4 key components or pillars for qualifying for a mortgage. Could we touch on what those are real quick?
Okay, and Chris is also going to cover the documentation that you need to verify the 4 Cs, so I'm going to try and avoid that best I can, so he has a spotlight on that too. But the 4 Cs would be capacity, capital, credit, and collateral. So when you're thinking about a mortgage, somebody's loaning you a large sum of money. So the main object is to figure out, do you have the ability to repay this mortgage back in a very common sense perspective, right? So your capacity would be how much income you earn in comparison to how much debt that you have. So your income is going to be you could be a W-2 wage earner. You could be self-employed. You could receive Social Security, VA disability, pensions. So those are all types of incomes. And types of debt, typical types of debts would be like student loans, credit card debt, minimum monthly payment on those, and auto loans. Those are really the basics there. For the capital component, that's your down payment funds and sourcing where they come from, whether it's through your bank, 401k, gift funds from family, friend, or employer, retirement funds. And then for your credit, that's going to be your credit report, your credit history. What's your borrowing history look like, and what credit score do you have numerically? Because that's going to help dictate what programs you qualify for or what program's going to be the best fit for you. Last one's going to be that last component, which we touched on earlier, would be the appraisal. So the lender needs to make sure that the house is worth what they're doling out for you to borrow. So those are the 4 Cs.
Capital portion of it, which is assets and down payment. So across the various different programs, all of them have their own maximum financing, minimum down payment. But that's not the number that everybody needs to actually know. So can you explain that to us a little bit?
Yes, thank you. Nice to see you guys this morning, afternoon. As you mentioned, I'm Chandra. I am a mortgage loan officer for KeyBank, and I'm going to discuss the money that's needed to close. So I like to break it down to, there's 3 buckets. One, you have your down payment, which, as Chris mentioned, if you use FHA, that's going to be 3.5% down. If you use a 3% down, or 3.5% down, if you use a 3% down program, it'd be that amount. Or if you use a no money down payment, then you don't have to worry about it. The second group is the closing costs. So in a closing cost, you have the loan origination fees, the lender fees. You're going to have your appraisal fee. You're going to have a credit report fee. And then your third item is going to be your title fees. So you are going to have title cost. A title company is the one that's going to facilitate the closing. They are the ones that are going to ensure that the property that you are buying is transferred, and to make sure that there's no outstanding liens on the title, so that you're getting a clean title, meaning that there's no tax liens, there's no judgments, there's nothing on the house that you're buying. So those title fees will protect you to ensure that what you're buying is clean and there's going to be no issues. The third bucket is going to be your escrows. So that is also called prepays, and that's money that you need to fund your account. I kind of like to say it's like a savings account that you're putting aside to pay your future property taxes and your insurance. Every month in your payment, you are going to be paying into that bucket, and then when your tax bill and your insurance come due, the lender will pay those bills for you from that bucket of money. Up front, you will have to preload it though with a certain amount based on the particular house that you find and when the taxes are due. And
some of these have an income cap, which is typically tied to the area median income. So southeastern Michigan, it's somewhere around $90,800, depending on the area. It's going to be family size dictated as well, where the home is for that income cap. Some have asset caps because these down payment assistance programs are there for the low to moderate income buyers to be able to receive some assistance and get into those homes. Some of these require that the down payment assistance portion, which sits as a second mortgage on the home. You have your regular FHA, conventional USDA, VA loan, but that down payment portion, that additional 3 to 6%, can be sitting on the home as a second mortgage, gaining no interest, with no required payment. Some require that that's paid back when you either move out of the home as your primary residence, when you refinance it, when you sell it or otherwise pay it off. And some of these programs have what's called a vesting, where after a certain amount of time, that loan, that down payment assistance may actually be forgiven. Some of them are 5 years, some of them are 10, some of them are even as long as 21 years of owning that property and living in there. And a lot of this is to increase home ownership in areas where it's down.
Our goal is the same as yours. We'd love to get you in the property as soon as possible, before contract day if possible. So for capacity-wise, Chris had mentioned earlier, we're looking to confirm that you have the income and the assets to afford the property comfortably. What we would do is an income verification, and you know your income situation better than anybody. So if you're a W-2 pay stub employee, we look for 30 days of pay stubs and the last 2 years of W-2s. If you collect VA or Social Security, pension, we would need statement verification of that. And if you anticipate utilizing income from business or self-employment or even rental properties perhaps that you own, we would need 2 years of tax returns, both from the business perhaps that you own as well as your personal. Additionally, we're looking for bank statements. Ideally, what we'd like to be able to prove is that you have the funds for the down payment and the closing, so we can effectively get you into your property upon application. Cash is not king, unfortunately, in the mortgage world. So if you have any funds that are not in the bank account at the time of application, they do need to be fully vested for at least 60 days before we're able to help utilize those funds for the closing of your home. There are other sources of income that you do not need to claim, but if you would like to utilize them, you are welcome to do so. They would include things like child support, separate maintenance income, or alimony. So if you have sources of those income that you would like to use to contribute toward your mortgage payment, we would need verification of those as well. Contrary-wise, if you have the obligation of child support, we'd also need to validate that for how long it's going to be continuing, continuing on, so we can count that as your liabilities as well. I think that's it.
Many people have had credit events in the past. So either a foreclosure, bankruptcy, bless you, something along those lines. What documentation or how far back should you go and provide that documentation?
Sure. So part of the questioning of the application is, have you had a foreclosure, bankruptcy, or short sale in the last 7 years? That does not mean that you do not qualify for the mortgage. It's just to help us to gather the appropriate documentation. Bankruptcies, depending on the chapters and depending on how long ago, you can go as in extenuating circumstances, we can explain away and have that foregone as long as you have a rebuilt credit history. But generally, bankruptcies, minimum of 2 years, in most cases, is going to be 4 years or more. The credit report, at least in my processing system, will help us to validate the date that your bankruptcy was discharged, and that's the date that we use. And FHA, it does need your case number needs to be assigned after that date. So if your case number is assigned on February 1st and your bankruptcy was discharged February 15th, we would have to have that case number canceled and then reassigned at that point. Oh, sorry, George.
That's okay. Is there a length of time on the job that, and it always used to be 2 years, right? So is that still in play, or is there something you can do about that if somebody just getting out of, college, maybe into a new job, has a salary, that kind of thing?
Absolutely. So Fannie Mae guidelines require that we verify income continuity or likelihood to continue. So a 2-year income history is what we like to identify or at least document. In the event that you're a student, we can also collect your diploma or your transcripts to show that you've been actively in school at that time. Part-time income does require a 2-year history at that employer in order for us to be able to utilize it, as well as secondary jobs. If you have your primary employment, I've collected the first pay stub after closing. So as long as it's a full-time W-2 pay stub employee, then we can use that almost immediately, but we do look very strongly at the overall continuity of that. Overtime as well does require a 2-year history because it's variable.
So if somebody was in the same field, yet they transferred to a different location, different job, that same industry, does that count as cumulative?
Yes, absolutely. So if you have a nurse that starts at hospital A,
Or fair housing.
It ties into a lot of things.
Yes. So we're ready? All right. Here's Leo.
I think appraisers cause the famines too. But good afternoon, everybody. I'm glad I'm going in front of Bob Taylor because he uses a lot of big words that I don't. And so that way I'm not going to be judged by what he had to say. My name's Leo Savoy. I'm an appraiser. I have been an appraiser. I think I did my first appraisal back in 1981. And I've seen the whole appraisal industry move from one direction with pens, pencils, everything written by hand, strike printers, databases that were hand calculated, listing tickets and filing cabinets that you had to keep track of, all the way to where we are today with MLSs, computers, instant access to data out there. I get phone calls all the time from people, from potential buyers, potential sellers, asking me to do an appraisal. And I try and talk every single one of them into not using my services. And the reason for that is in most cases, I think that the real estate agents can come up with a very similar number, completely different technique, but at the end of the day, they should be able to come to the same answer that I do. The only time that they need me is if they need a specific form whether you're fighting the IRS for estate purposes, divorce purposes, or if you get into very unique properties where it just doesn't fit into the normal trend. And in that particular case, they may want to engage my services, but they don't need to pay me $500, $600, $700, $1,000 for something that the real estate community, realtors in the area, have the skill set to guide both buyers and sellers. But I will tell you what happened just this past week where I did do one. Somebody sold a house for $769,000. The first appraiser that went out there appraised it for $730,000. So the bank then sent another appraiser out there, and that appraiser appraised it for $700,000. From a loan standpoint, it didn't matter because the buyer was putting $500,000 down. But the buyer called me and said, I'm really concerned, am I overpaying for the property? He told me where the property was, and I said, I can tell you exactly what happened there. That somebody, if they came in from out of the area, there's a dividing line in the neighborhood. And that dividing line is called Grant Street. And anything to the east of Grant Street will sell for $100,000 less than anything to the west of Grant Street. Because west of Grant Street was built in the 1950s, have different types of foundations, have different types of wiring, have different types of plumbing. Where east of Grant Street was built in the 1920s. So as one of your inspectors we just talked about, knob and tube wiring. They have knob and tube wiring. They have galvanized plumbing. They have sewer lines that will collapse on you. So if that appraiser didn't understand the nuances, he will come up with the wrong answer. So in this particular case, I said, yeah, I'll go ahead and do it if that helps your comfort level to get to where you want to be. In terms of the lenders out there, most of the lenders have AMCs, appraisal management companies. Personally, I don't work with any AMCs for a number of different reasons. I know why the lenders have it, because of the speed, the cost. It takes one burden off of them, but I will tell you, many of the AMCs out there feel that their best appraiser is the one that will do it the cheapest and the quickest. Most of the time that works fine, but when you get into unique properties, it definitely doesn't help anybody that is looking to either buy a home, sell a home. The other thing out there with the appraisal management companies, they can be in California, they can be on the East Coast, the West Coast, and again, they just hear Midwest. The Midwest is the rust bucket. It's collapsing. And they don't understand the local markets. The other problem with appraisal management companies, it's going to be...
The next thing that happens after you buy a house, or when you actually own the house, is that the taxable value is artificially capped. It can only go up 5%, or the amount of increase in the area based on a sales study that's either 1 or 2 years, whichever is lower. So if the sales study shows an increase of 3%, but the consumer price index went up 5, guess what? It's 5%. If the consumer price index went up 7, it's still only 5%. So this is something to be aware of. That's relative to taxable value. What happens to property owners, and this is why this is important, is that you're going to get qualified based on current taxes, based on the current taxable value. When you buy the house, the cap is taken off. The taxable value is now reconciled to the state equalized value, and then the state equalized value goes up whatever the sales study shows. The state equalized value is not capped. So for example, in Bloomfield Township, where I live, the state equalized value is going to go up 7%. Taxable values only go up 5%. However, if I bought a house, not only would my taxable value now become my state equalized value, but my state equalized value would go up 7%. and then it gets recapped, and that's why frequently you hear people complaining about their taxes after they bought a house. These are important questions. Now, there's a lot of stuff that's been talked about today, and I guess one of my concerns is nobody should be scared off from buying a house. So let me explain why. I bought my first house in 1974. I paid $42,000 for that house. It was built in 1929. It didn't even have a dishwasher in the kitchen, didn't have a fireplace, and had 1.5 baths. When I sold it, it had 2.5 baths, a redone kitchen with a dishwasher, and it had a fireplace. And I sold it for $200,000. It was well worth the time and effort that I took to buy it, fix it up, and sell it, and that's how you build generational wealth. Any questions about taxes? Is that good enough?